Welcome to Alo Speaks with Alo Patience. Today we will be discussing on a topic, risk associated with cost of capital. This would be our fourth topic on Module 3 in the course Corporate Finance. If you have not watched our previous topics, I would advise you to do so. I am aware that most of us here do not have a business-oriented background as our first degree. However, do not worry, I will be breaking to this class to be as simple as ABC. In today's class, we will be discussing about how risk is related to cost of capital, explain the different types of key risk components and their peculiarities. Before investors and shareholders give out their fund, they do not only want to know the returns expected from such funds, they also want to know the risk associated with parting with their funds. As there is no investment that is without risk, but there is no business without a level of risk, except government bonds. So since risk is an inherent part of investing, the investor must be willing to take on a certain amount of risk in order to be able to earn a return. However, it is the job of the financial manager to mitigate this risk so that it doesn't have a negative impact on the overall financial situation. There is nothing like a bad risk and a good risk. Some level of risk is necessary in order for us to earn a high return. This means that the higher the risk associated with an investment is the likelier the higher the return. That is, the higher the risk, the higher the compensation is likely to be. However, we can still manage risk by diversifying our portfolio. That is, spreading our funds to multiple investments instead of concentrating your fund in just one single investment. If the cost of capital to invest in a project is 10% and the investor now discover or observe a risk, they would demand for a compensation rate higher than the initial 10%. That is higher than the expected 10%. Therefore, risk is the difference between actual return and expected return due to the element of uncertainty. This means that risk is an uncertainty that may likely occur, and this makes investors to ask for higher compensation. Please note that risk is not a feeling. It is something that can be measured quantitatively. We have various types of risk. We have the risk-free rate of return, the business risk, the credit risk, also called the financial risk sometimes, the liquidity risk, the exchange rate risk, the country-specific risk, the inflation risk, the market risk, the reputation risk, the operation risk, just to mention but a few. But among all these risks I just mentioned, the three key risks include the risk-free rate of return, the business risk, and the financial risk. I will explain what some of them actually means. The risk-free rate of return, it is that rate where you are faced with zero risk, yet you still enjoy a return. It is usually the rate you can get from the bond market. That is through the debentures and treasury bills that are issued by the government. Those type of investments, they have zero risk because the government can never default in paying up. After all, no be dem dey print the money. In Nigeria, bonds and treasury bills, they are sold with zero risk, and they are sold in various denominations from as low as 1,000 naira denomination to as high as 5 million naira denomination of bond. And because they are issued through a competitive bidding and at a discount from par, it appreciates and provides a return for the holder. Now, business risk. Business risk is a risk of uncertainty of unexpected events beyond the control of the firm that may result in a loss or lower the profit or cash flow. And once such risks are identified, the investor would demand a higher compensation above the risk-free rate of return. Like I said in the previous example, assuming the risk-free rate of return is 10%, now the investor will demand a higher compensation above 10%. So how do we determine business risk? By looking at the history of their cash flow. Firms with history of stable cash flow may have a lower business risk than firms with volatile, unstable, and unpredictable cash flow in the past that varies from quarter to quarter. Financial risk, but I would like to call this credit risk. This is the risk that the borrower will fail to repay their debt or the interest of their debt in full or in part when it falls due. And this will now result to a loss to the lender. This is a risk associated with uncertainty that a company has the ability to settle its obligation as at when due. What I am saying here is that if we know say company A sabi owe gbese, before we go borrow am more money, we go ask for a higher compensation above the risk-free rate. And the more the debt obligations or the more the loans a company has, the higher its credit risk. Therefore, the higher the compensation potential investors would demand for. What about liquidity risk? We can view liquidity risk in two ways. It could be an inability to meet your short-term obligations as they fall due. This is a funding problem, a working capital problem, where you are not able to settle your current liabilities with your current assets. But that is not the one we are looking at right now, when we are talking about liquidity risk here as it relates to cost of capital. Here we are seeing liquidity risk is our inability to realize cash immediately with less cost. That is the risk associated with inability to dissolve your investment quickly and cheaply at minimal cost. This is a risk associated with uncertainty of you exiting from an investment quickly and cheaply. This type of risk is mostly associated with financial instruments and not physical projects. The greater the time it takes for you to exit from that investment quickly and cheaply, the higher the compensation potential investors would demand for such an investment. The exchange rate risk. We can call it the foreign exchange risk or even call it the currency risk. This is a risk that is associated with investment dominated in a currency other than the currency of the investor, other than the domestic currency of the investor. Let me give an example. A Nigerian investor wants to invest in a project in Benin Republic. We know that the currency being used by Nigeria and Benin Republic are different. And so there may be an exchange rate problem, an exchange rate difference that varies from time to time. This is called the exchange rate risk. So we can see that this is common with international transactions across borders, where a shift in the exchange rate can cost the investor very dearly. So the greater the historical variation that exists between these two currencies, the greater the amount of compensation that potential investors would demand. Country-specific risk, as the name implies, risks that are specific to a particular country. This means we are discussing about another transaction across borders. This is a risk that is associated with investing in a particular country. That is what is happening in that country. It could be risk due to policy changes overthrow of government, tribalism, terrorism, economic collapse, political unrest, and even war. And investors would want a higher compensation if they are to invest in such a country. Countries like Canada and Japan, they have low country specific risk,
as they are first world countries and they have very stable economy.
while countries like Israel that are known for their history of war, of unrest, investors would demand a higher compensation to invest in such countries.